I kept losing thousands in the stock market, not because I was picking bad stocks, but because I would always sell at the wrong time. The problem was that I was controlled by greed and fear, and there was a complete lack of process. But over the last 10 years, I learned from my mistakes and became consistently profitable. I took what I learned and rebuilt everything into a simple system designed for everyday, hardworking people like yourself with jobs and families, a system that our members have used to double their accounts over the last 2 years. Now, in this video, I'm going to walk you through the 4-step process so you can build consistent returns without staring at charts all day or second guessing every single move. Now, most investors don't lose because they can't find a good stock. They lose because they're looking at too many stocks in the wrong way and with no filter. This is where most people unknowingly sabotage themselves. They're bouncing between headlines, opinions, and random charts, trying to spot something. And that's exactly how you end up forcing investments, buying late, or even getting shaken out way too early. So step 1 is simple. We're going to filter the entire market down to a short list of stocks that are actually worth your attention. The ones most likely to move in clean, profitable trends. Investing in every appealing stock you come across is like trying to find a serious relationship by saying yes to everyone on a dating app. You know, that constant swiping, right? You're not increasing your odds, you're creating chaos. Investing works the same way. No filter means bad choices. And this filtration process is outlined inside our stock market blueprint. It's the same tool our community and I use every week to filter the market and find stocks with the potential to rise 80% and more. I put the link below so you can download it. All right, so to show you what I do when I run this scan, here's what the result looks like. I use my scanner to go through thousands of stocks daily and shortlist those that meet a specific criteria. This is a recent list that I have exported into this spreadsheet. Sometimes it gives me around 50 stocks, sometimes it gives me hundreds. It really depends on how bullish the market is on any particular day. Now, the key thing we're scanning for is simple. Stocks that are breaking through previous highs, so levels of resistance and looking to push further up. Let's have a look at some examples on a chart. Okay, so we're on the daily chart for Phillips 66. So if you see this level right here, if I just mark this level, what we have is a previous high or a previous ceiling. Price has tried to go through it right here and failed. And then following that failure has tumbled and has continued moving back to the downside for several months. What we want is a stock that doesn't just tap this level. We want it to push through and start holding above it, because that's the market proving that there's real demand for this stock and it's looking to push higher. Okay, so now here's where the filtration really kicks in. Just because something is breaking a high doesn't automatically mean it's a good investment. So let me show you an example of what we do not want. Okay, so here is the daily chart for ExxonMobil. If we look to the left-hand side, there was a previous high where the market failed and it moved back down. So if we just get the marker and mark that high, we can see that from this point here, it moved back up, and it's at this level here where it actually attempted to break out and move above that level of resistance or that ceiling, and then it failed and remained below it. Ultimately, it's still stuck in that messy consolidation and it's really just chopping sideways. Once you get triggered in and it dips back into the range, then typically mind games start taking place and you'll start second guessing yourself. And you're right back into that emotional cycle between fear and greed. And ultimately, if you buy this, you're basically signing up to get whipsawed in and out of positions. Now, here's the next stock, Argon. Again, looking at the daily time frame, there's a previous high here where it failed and moved down. So let's mark that again. And what we can see is the same thing, really. A breakout attempt here, failed, big gap down, just really spikes and a lot of volatility where the stock has remained inside this consolidation. There are no smooth trends, just drops and spikes and messy moves. This kind of volatility really makes the stock unpredictable. It makes it harder to hold. Now, even if the stock moves up and in our favor, well, the psychology starts kicking in because the dips can be large. And then again, it feels like every move could be a potential reversal in this stock. So again, stocks like this that don't really trend well, that don't have smooth moves up to the upside and ultimately have dips and swings, we want to avoid. Every dip in this stock could potentially feel like a collapse, and we really want to avoid that. So stocks like this absolutely get removed too. And then I'll check the history, because history absolutely matters. And we'll look at that in a second in more detail. If a stock has a track record of clean trends, it moves up, it respects pullbacks, and it makes progress over time, it's more likely to do that again. But if the history is just random surges and collapses, it's basically telling you I don't trend well, and we're trend followers. So we don't waste time trying to force those volatile stocks to work, particularly when we have a lot of options. So what I'm doing on this scan list is really, really simple. I'm not trying to convince myself to buy something. In fact, the complete opposite. I'm trying to eliminate anything that doesn't match what we want until I'm left with a short list of the strongest candidates, the ones that are clean, trending, and actually worth a closer look. And once you filter the market like this, the next step becomes ridiculously fast, because now you're only looking at quality over quantity. So now I'm going to show you how I can look at a stock and know if it's a high performing opportunity in about 3 seconds. So stay with me. Investors overcomplicate the simplest part of investing. I've seen people running multiple screens on their desks packed with charts and indicators, convinced that the more information they see, the more money they'll make. But it actually works the other way, because profit doesn't come from having more information. It comes from seeing the right information clearly. When your screen is cluttered with lots of indicators, you don't get confidence, you get noise. And noise doesn't just confuse you, it quietly pushes you into the exact mistakes that drain accounts. Hesitation, second guessing, chasing confirmation, and reacting too late. All of these mistakes will cost you. That's why less is more, not as a preference, but as a competitive advantage. When you remove everything that doesn't matter, the market starts to look different. Patterns get easier to spot, decisions get faster, and you stop needing to feel your way through investments. And the best part is you don't need a complicated setup to do it. You need a simple one that forces focus. Okay, so let me show you what my setup actually looks like on the screen, because this is the whole reason we can move fast without guessing. Okay, so what you're looking at are 3 charts of the exact same stock, all on one single monitor. Top left is the monthly time frame, top right is the weekly time frame, and the big chart here across the bottom, this is the daily time frame. And notice what you don't see here. There's no clutter, no indicators everywhere, nothing fighting for your attention. I want the charts clean so you can see exactly what I'm looking for. So we're focusing purely on the price of the stock. Now, watch how simple this is. I start up here on the monthly time frame, top left. This is the bird's eye view. I'm asking one question. Is the long-term trend up? So I'm literally looking from left to right. And if the overall slope of the stock is up, well, that's the stock doing higher highs and higher lows, and it's rising. Well, that's a trending stock. That's exactly what we want. Now, if it's flat or if it's sloping down, I'm not negotiating with it. That stock is gone and I move on. Then next, I go to the weekly time frame, top right. Same idea, but just zoomed in closer. And I ask myself the same question. Is the weekly also moving up? And is it moving up cleanly? And we can see that this chart has a very clean move to the upside, because I don't want something that's all over the place. I want something that's making steady progress. If the weekly is messy, choppy, or is clearly not trending, again, that stock is gone. Okay, then I drop down to the daily chart along the bottom. And again, I'm looking for the exact same thing. Is it moving up right now? And if it is, and it's aligned with the monthly and the weekly and the daily, and they're all moving up together, that is a good looking stock. So here's the key. When all 3 time frames line up like this, the monthly is up, the weekly is up, and the daily is up, that's a green light. That's strength stacked on strength. But the moment I see just one of those time frames not moving up, even just one, I don't try to talk myself into it. I ignore it and move to the next chart. And this is why it's fast. This is why this 3-screen setup is efficient. I'm not doing deep analysis on every stock. I'm running a simple alignment check, making sure the monthly, the weekly and daily are all moving in the same direction. And that's it. So when I go through hundreds of charts, I'm basically doing the same scan with my eyes. Monthly, weekly, daily. Yes or no? Next. And the stocks that pass this test are the only ones that make it through to the next stage, because we're not dealing with hundreds of maybes. We're now dealing with a much shorter list of only the strongest candidates. And in the next step, I'll show you how we take that short list and cut it down even further until we're left with the best handful of positions using the next part of the process. Okay, now that we have fewer stocks to look at, we can go through the process that requires a little more attention to detail for step 3. It's where we sift out the high probability stocks. Now, with fewer stocks, we can spend a bit more time looking at the charts to spot things we did not see in the previous 3-second process. There's always stocks that you might look at that appear to be good opportunities, but when you walk away from your screen and come back to it a few minutes later, you can clearly see that it's not as obvious an opportunity as you may have initially realized. So we always want to have that reset period where we do the 3-second process of looking through the chart, taking a break, and then coming back and looking at the screen with fresh eyes. That way, we can easily spot things that shouldn't be there. Now, I've used this process daily over the last 10 plus years I've been investing, and it works really, really well. And we've been able to find stocks that outperform the indices consistently, so that when you see the S&P 500 declining, our stocks are still moving up and barely taking a hit. And when I show you how to spot things we don't want to see in a stock, you will be able to find high probability opportunities as simply as we do. Okay, so now we're at that point where we've already done the heavy filtering. We're not looking at hundreds of charts anymore. We've got a handful. And this is where we do the fine tuning, where we take the good ones and narrow it down to only the highest probability opportunities. So here's the main thing I'm looking for at this stage: a history of clean, linear trends. And when I say linear, I don't mean a straight line with no pullbacks. I mean it moves up smoothly. It prints higher highs and then higher lows. And when it pulls back, those pullbacks are shallow. It doesn't fall apart. It dips, it holds, and it keeps pushing to new highs. So let me show you what that looks like on the charts. Okay, so we're on the daily time frame for Amphenol. And if you look at this stock, see how smooth it is, how clean it moves to the upside. It's not spiking up and collapsing. It's not whipsawing around. It's just consistently moving up. And these little pullbacks along the way, well, they're small. It finds support, and then it gets right back to making new highs. That's what we want in a clean, linear stock, because a stock like this tends to add very healthy profit steadily into your portfolio. It's absolutely not a fight to hold it. Now, a quick point: just because a stock hasn't trended like this in the past doesn't mean it can't in the future. It just means the probability is lower. And at this stage, we're playing the probability game. We want the highest odds. Now, I've seen plenty of stocks that were messy for many years, and then suddenly their behavior changed and they started to trend beautifully. But the problem is you don't know when that's going to happen. So we don't build our portfolio around maybe. We build it around what the stock has proven it can do. Okay, we're now looking at the daily time frame for Comfort Systems. And again, you can see just a very clean stock that has moved very nicely to the upside, handing out excellent profit for investors. Very strong, very smooth from this point here to this point here. Then it went through this sideways period, a volatile sideways market where it wasn't that clean anymore. But then right here, it breaks out, and notice what happens after it breaks out. It goes back to that cleaned, controlled move to the upside. This is exactly the kind of stock that gets shortlisted from our scans, because basically it's showing us I know how to trend. I've done it before in the past, and I'm very likely to continue doing it going forward. Okay, so here's another example. This is Keysight Technologies. Again, we're on the daily time frame. Notice this stock has a strong history too, very clean linear move to the upside. But then you also notice that it went through this long-term area of consolidation. And then once again, that's not a bad thing. Remember that a stock that's moving sideways forms a base for the next leg up. And then when it broke out, it's continued that clean linear move to the upside. That's exactly what we are looking for in terms of the personality of a stock. When it trends very well. So even while it's moving sideways, we're not forcing it. We're just waiting, and then when it finally breaks out of that area of consolidation, as it did here, it starts moving nicely up again, and now it has the potential to build another clean linear trend to the upside. So Keysight Technologies absolutely stays on the shortlist. Okay, now here's another example. This is Lowe's Corporation. Now at first glance, it actually looks like a decent stock. It's moved up quite cleanly, but if you look closely, these pullbacks tend to be quite deep and quite messy. The corrections are heavier and it tends to chop around. And so that tells me that this is a slower moving stock. It doesn't mean it's a bad stock. It just means it's a slower moving stock and that it still has the potential to trend for weeks and months. But if we're choosing the best of the best, I don't want something that potentially makes me sit through deep drawdowns like this. What we're looking for are much cleaner, much more linear opportunities. So I don't throw this in the trash forever. In fact, I just simply put it aside and look for better, cleaner, more linear opportunities. Okay, so here's another example. This is Lam Research. Again, it's on the daily time frame. See how smooth this uptrend is? It trends cleanly, it respects pullbacks, and it keeps progressing higher. This sort of price action, this is exactly what we want. So this absolutely goes onto the short list. And that is basically the process. At this stage, we're not adding complexity, we're doing the complete opposite. We're simply studying the history of the stocks that already passed our filtration system, and we're selecting the ones with the strongest, cleanest trending behavior, because that's what gives us the highest probability chance of success. And this is how we keep it simple and grow the account consistently over the years. Okay, so now step 4 is where everything comes together. We've done the filtering, we've confirmed the trend, we've shortlisted the strongest candidates, and now we hit the part that actually turns all that work into real results. And this is the step that quietly separates investors who stay consistent from investors who stay stuck. Because what usually happens is people do the hard part, they find a strong stock, and then they fall apart at the easiest moment. They hesitate, they second guess, they start asking, what if I'm wrong? They look for one more signal, one more opinion, one more reason to delay, and while they're doing that, the move happens without them. So in this final step, I'm going to show you how to remove that hesitation completely. The simple rules that tell you exactly when to enter, how to protect yourself if you're wrong, and how to stay in that investment long enough to actually get paid. Because when you have that piece locked in, the whole system comes to life. And again, if you want this full process mapped out properly, it's inside our stock market blueprint. Okay, so now I'm going to show you exactly how we enter these stocks once they made it through the filtration system, where I place my stop loss so we can exit at the optimum level to minimize loss if the market moves against me, or to catch good profit when the market moves in our favor. So let's move back to the charts. Okay, so what we have here is the daily charts for Amphenol. This is the breakout signal, the breakout candle that I'm looking for. This is the confirmation that the stock is actually worth taking a position. Now we've got a tool on here that highlights breakout signals as they happen. Note that we don't take the first breakout signal. I like to wait for the second or the third breakout signal from an area of consolidation that actually confirms that the uptrend has started. So if I mark the high of this area of consolidation, we can see that it's not the first signal that interests me, it's the third signal that actually confirms that an uptrend is in play. And the reason I like to do this is that it helps avoid a fake breakout. I like to wait for further confirmation that an uptrend has actually started. Okay, so now that we have our breakout signal, Watch what we don't do. We don't just jump in at market prices just because it looks good. A small breakout like this may still turn into a fake breakout where it reverses back into this area of consolidation. We absolutely want to avoid that. Instead, what I do is I set my entry above the high of that breakout bar by a few points. What I'm actually saying here is that if price proves itself and moves up to that level, then I want to buy. So I go to my broker, I place a buy order at that exact level, a few points above the high of that breakout signal, and I choose how many shares I actually want. Typically, no more than 2% risk allocation worth of shares. Now, the next part is actually the most important part of the whole system, the stop loss, because this is what removes emotions. So let me add that onto the chart. Okay, now what you can see on the charts are Donchian channels, and I like to use the Donchian 20 setting. That marks the lowest low of the last 20 trading days, basically the lowest point over the last month. And that's significant because if price breaks through this level, it's telling us something extremely important. The trend we thought that was initially strong actually isn't and has failed. So my stop loss goes right here at that Donchian 20 low. And the logic is uber simple. If I get triggered into my position above the high of this breakout signal and it reverses and breaks that Donchian 20 low, that stock has failed and I'm out. No debate, no hoping, no let me give it another day. I take the small loss and I move on to the next opportunity. Losses are part and parcel of the process. The goal is to keep them small and manageable and the profit large through letting winners run. Now, you've heard the expression cut losers short and let winners run, and the trend is your friend until the bend at the end. These are timeless mantras. So now, if the stock behaves the way we want and starts handing out profit, something great happens automatically. As price moves up, the Donchian 20 low moves up with it. So our stop starts trailing behind price, which means we're not just making profit, we're locking it in as the stock continues trending. And that's how we exit too. We don't exit because we feel like the market has topped or because some influencer said so. They often come with embarrassingly wrong track records of being wrong. And remember, one of the first rules of investing is to ignore opinions, including your own. Instead, we always let price dictate and we react accordingly. So we only exit when price breaks down through that Donchian 20 low, because that's the market telling us that the trend has changed direction. So let me show you again how that looks on the charts. Once again, right here is the breakout signal. Our entry goes a few points above that breakout bar. If the market continues higher, we get triggered in. Our stop loss is right here at Donchian 20. This is our initial stop loss. Okay, so it's around here that we enter into the stock with our entry a few points above the breakout signal. Here is the Donchian 20 low. Now you can see as the days unfold and the trend develops and walks along the upper Donchian, you can literally watch the stop loss following price action as the stock moves up. Notice how smooth this is. This is the kind of stocks that we want. Clean trends and how the stock follows, and we're just basically managing it without any stress. Then eventually the trend ends, price reverses, and it tags and breaks the lower Donchian, and that is our exit. Now, I like to personally look for 2 breaks of the Donchian. We can see that there was one here, and that allowed the trend to recover and move further up. I like to look for 2 breaks, and it's the second break where I then manage my exit. No guessing, no emotion. The system tells us when we're in, and the system tells us when we're out. And this is why the math works. If the trend has failed, we're usually taking a small hit, around 1 to 2%. Personally, I prefer going down to 0.5%. But when we're right, a clean trend can pay us 5%, 10%, and so much more. And some of these trends run for months. 12 to 24 months is not uncommon, which means we're not just getting one opportunity. We can buy more shares at multiple points, trail the stop, and keep locking in gains as the stock moves up. Do this across multiple strong stocks, what we call a portfolio, and that's how you start growing an account consistently with exponential growth over time. You've seen how I use my 4-step process to make consistent profit. There are also 4 phases I use to identify high probability setups I use on my charting software. Watch this video where I take you through these simple phases.